Interbank lending market. The interbank lending market is the wholesale system where banks lend reserves to each other, usually overnight, to manage daily liquidity gaps and meet regulatory requirements. Banks with excess reserves lend to those with shortfalls, creating the foundation for key short-term interest rates across the economy. This mechanism produces benchmark rates like SOFR and Euribor, which guide broader financial markets. The interbank market matters because it's the pulse of the banking system. It's where banks lend to each other and where central banks transmit policy rates. Rates like SOFR and Euribor don't stay in the banking world. They directly influence the cost of loans, mortgages, and even derivatives for consumers and businesses. When these rates spike, it's a red flag for liquidity stress, as we saw in 2008. But when they stay low and stable, it signals normal, healthy market functioning. Let's walk through a real-world example. Bank A has $100 million in excess reserves, while Bank B is $50 million short due to client withdrawals. So Bank A lends Bank B that $50 million overnight at 5.25%, earning roughly $7,292 in interest on that single loan. Now, that may seem small per transaction, but when you consider the daily volume in this market reaches hundreds of billions of dollars, interbank lending becomes a major profit center for large banks, with repayment happening the very next business day. Traders and treasurers use interbank market data in 4 practical ways. They track the spread between SOFR and T-bills. When it widens, it signals rising counterparty risk. They also trade SOFR futures, or OIS, to hedge funding costs, lock in borrowing rates through swaps, and watch these instruments for clues about future central bank policy moves. A common pitfall is mixing up interbank rates with central bank targets. While the Fed sets a goal, actual rates fluctuate around it. Remember, unsecured loans like Eurodollar deposits carry more risk than secured repos, and never assume zero default risk. 2008 proved markets can freeze. Key benchmarks like SOFR, SONIA, and Euro STR trade billions daily.